We'll kick off the conversation with an introduction to each panelist. Let's begin with Jonathan.
Prior to this, I was a quant portfolio manager at a few different hedge funds and at GSAM and at Goldman. This slide is sort of a reflection of where sort of ESG is going in terms of its data. And I think web scrape data and third-party data is becoming more and more important with our focus on ESG. And then lastly, I'll just mention that please check out AllianceBernstein's new corporate sustainability report that we just released, and it's on our website. And from a data perspective, it's actually sort of interesting in that I didn't really have a big part in how we put that data together, but it was nice to see that we could, an institutional investor could easily go to the website and find the source information for what we were reporting. So you could see the source information for our carbon, our source information for our wage gap information, and so it was really kind of nice for an institutional investor if they really want to dig down and see the numbers. So I have to commend them, and so please check out that website.
Cool. Go on, James.
Great. Hi, everyone. My name is James Yo. I'm a sell-side research analyst at Bank of America. Our team covers U.S. equity and quant strategy. So we do a lot of different things. We set targets for the S&P 500 for the year-end, 10-year targets. We have sector views. We form our house view on the overall U.S. equity market, essentially. On the quant side, we do a lot of factor analysis, factor investing research. We do a lot of positioning and flows work. And I guess ESG has sort of been, when we first started, taking on this initiative, it was a few years back, and was sort of a segment within the quant strategy where we looked at ESG as sort of as a factor, just like any other factors that we track. And we soon realized that the demand for this type of research is more than just from the quant angle, and there's a lot, and really a lot to be done in ESG research. And when you hear our CEO Brian Moynihan talk about some of our initiatives at Bank of America, responsible growth is definitely one of the top keywords that he always uses. So in research, we've been looking at a lot of different ESG trends and factors, et cetera. So on the screen, this is from our most recent report on ESG called Top 10 Reasons You Should Care About ESG. And before, I guess just briefly introduce what we've done, but I guess ESG stands for environmental, social, and governance, in case you haven't heard of it. So it's basically non-financial attributes of companies and securities, investments, whatever you're considering, that have been material to companies' financial performance, stock performance, et cetera. So the dashboard basically shows you the top 10 reasons we think that every investor should care about ESG. And I'm excited to talk about it a little bit more.
Yeah. Jen, please go on.
I'm Jen Fela. I'm the Global Engagement Lead for the Plastics Campaign at Greenpeace. And so we specialize in ESG before it even had a name, I would say. We've been around for 30 years campaigning on companies and basically calling out companies that have bad environmental practices and then celebrating the ones that have good ones. And so on the slide are two reports that we put out last month that are just an example of the type of stuff that we publish. The one on the left was a report called Throwing Away the Future, and it's about plastic pollution is a really complicated issue, right? And there's a lot of companies, the public awareness about this is dramatically increased in the past 5 years. And so companies are making commitments and saying, yes, it's our single-use plastic out there that's polluting the planet, and we're going to solve it. But a lot of the ways that they're trying to solve it are not sustainable. So it's things like replacing plastic with paper, replacing plastic with bioplastic, which has a whole host of issues around it, chemical recycling, which has a lot of problems, and investing in more recycling, which I hate to say is a broken system because only 9% of plastic is actually recycled. And so if we keep relying on that system, it's just not a good way to solve this problem. So this report on the left basically calls out those false solutions, and then we advocate for the only real solution from our perspective, which is reusable and refillable systems. So companies that will commit to peak production, that the amount they produce now is the highest amount they will ever produce, and they're just going to commit to reducing that amount by moving towards refillable and reusable systems, those are the ones that we will celebrate. And all the other ones, we're going to call them out. And the report on the right is with a coalition group that we work with called Break Free from Plastic. So there's over 1,800 organizations currently in Break Free from Plastic. So this is a report we put out with them where you may have heard of this one. So we did cleanups all around the world and named the top polluting companies that we found. So it's literally going and doing a cleanup and tallying the number of Coke products, Pepsi products, Nestle products that we find at the cleanup. So it's tedious, time-consuming, but it's really valuable data. And no company wants to be named in this report as a top polluter. So that's just showing some of the data that we're collecting to show if these solutions are working or not. So far, none of the solutions that we call out in the report on the left is going to keep a company from appearing in the report on the right. And so that's really the key thing that we're trying to say is like, we need to do something to stop this throwaway single-use culture. That's the real problem, and move towards the reusable, refillable systems. And so that's the kind of data that we provide.
Great. Okay, Tensie, you're up next.
So I'm Tensie Whelan. I run the Center for Sustainable Business at NYU Stern. How many people went to NYU? Any hands here? Yeah, good. Love you. At the center, we are helping current and future business leaders learn how to embed sustainability core to their business strategy to drive innovation, operational efficiency, competitive advantage, value to society, et cetera. And we have a number of different research projects along with the work we do with students. One of the research projects was working with IRI, which collects all of our data when we go and shop at retail through the barcode information, particularly around consumer packaged goods, or CPG. And so we were intrigued because we had heard there's a lot of surveys out there saying that, you know, in terms of sustainable products, people say they want to buy them, but then there's a green gap. In other words, they say it, but then they don't actually go purchase them. But when we looked, we couldn't find data of actual purchasing, just the survey data. So we partnered with IRI to look at 5 years of data across 36 of 40 CPG categories. We looked at 73,000 SKUs or products to determine what kind of trends there were in consumer purchasing of sustainability marketed products. And what we found is that the current market is about 16.6%, which is not at tipping point yet. It's worth about $114 billion. But the interesting thing is what you see on this slide, which is in the last, from 2013 to 2018, which is when we did the study, 50% of the growth in CPG came from sustainability marketed products, which in CPG, you generally have very low growth rates, right? So a really fascinating and important area because it requires now companies to recognize that there's a big shift going on in consumers and that they need to begin to produce sustainable products. And you're going to ask me, I know, about what's the difference between sustainability marketed and sustainable products, which I'm glad to answer. And we also saw, which we'll talk a little bit about, you know, different categories growing at different rates in this work.
Right. So Tensie, let's start here. Can you tell us a little bit more about the landscape of sustainability marketed products? Which categories are the top performers?
Yeah. Well, so it's really interesting to see. One of our theories going in is that there's a hangover of opinion about products where people think of the 80s and like something's crunchy granola and it's not going to be effective and it's not going to taste good and you're going to have to pay more for it, right? So what we're seeing, though, is that is a change. So what we thought we found, which is that those things that require them to be efficacious, like, you know, laundry detergent, like it's got to work, or sanitary napkins, they've got to work. So when you buy them, you're thinking, I care more about that than whether or not it's sustainable. And so we found that those types of products tended to be the ones with lower market share of sustainability market products, less than 5%. But And products like yogurt, we saw 70% of some type of sustainability claim on yogurt. And we also found, like with milk, that actually milk would have been, the growth rates were below zero, except for in the sustainability marketed categories. But then what was interesting is that we also found that those areas with 100 to 150% growth rate, so above your standard 50%, were those categories like laundry detergent, sanitary napkins, laundry care, et cetera, deodorant, that had been lower parts of the lower percentages before are now the ones with the highest growth.
Got it. And it seems like there's still quite a bit of skepticism around sustainability from a business perspective specifically. Why do you think that is?
Wow, there's so many reasons. Like, got an hour?
Right.
So why is there skepticism? Well, first, I think there's skepticism about the business case, right? There's skepticism about whether consumers will purchase this. There's skepticism about how much it's going to cost them to put in place the requirements that are necessary. There's also just sheer bureaucratic inertia. You've been doing something the same way for 20, 50 years. Your buddy who you purchase stuff from, you play golf with, you don't want to upset that. I mean, there's like all kinds of reasons that go to internal change management. There's a lack of innovation. There's also a lot of work that we're doing, again, using data, is tracking the return on sustainability investment. Companies are not actually tracking those returns. They're making the investments in some cases, but they're not tying it back to what kind of business case they're making. So one just really quick example of that, and I think if companies begin to shift this, they will take up sustainability in much bigger numbers. We worked with GM, VW, and Aston Martin to apply this methodology to the automotive sector, and we were applying it now to the apparel sector. For one waste management strategy, one practice is to recycle paint and solvents. When you recycle paint and solvents, you no longer buy the virgin paint and solvent. You no longer pay for the waste disposal. And actually, they said it had some left over, so they were selling the recycled product. All of those things actually resulted in serious money, but nobody was actually pulling all those different cost savings and revenues together and tying them back to their investment in that waste management strategy. As an example of why, again, I think companies are skeptical because they're not actually doing the due diligence and understanding, the financials of what's needed to move them to that next level of sustainability.
Right. So in Tensie's research, the phrase sustainability marketed products really stood out to me. So on both Tensie and Jen, if you could tell us, how do we separate good commitment to sustainability from greenwashing? Can you share an example? That would be great.
Do you want?
Yeah, Jen, go ahead.
Yeah, there's lots of examples. So what I described between throwing away things and replacing them with more throwaway things, bad commitment. Reusable things where you're not producing throwaway material packaging, that's a good commitment, and we're not seeing enough of that yet. A good example of that would be Loop, that system where you can deliver like a stainless steel container of ice cream or something and then get that same container cleaned and refilled by the company. So companies are starting to invest in that, not nearly at the scale that is needed from our perspective, but that's the type of thing that we would look for and think is a good commitment because it's focused on getting rid of this throwaway stuff and focusing on reusable stuff. An example of a greenwashing commitment is something where a company would consider the consumer concern, do something that appears to be solving the problem, but actually is either making it worse or not solving it at all. For example, Starbucks, and I'm sorry if anyone from Starbucks is here and I'm going to embarrass you a little bit, but so there was this public outcry over straws because of this terrible video with this turtle and he had a straw stuck in his nose. It was really sad. So people got really upset about straws, this whole outrage about it. So Starbucks says, okay, we're going to make a commitment to solve this problem. We're going to get rid of straws. And now they have what can really only be described as an adult sippy cup lid that is actually more plastic than the original lid plus straw combination. So the problem is not actually the straw. It's sad that that happened to that turtle, but the problem is plastic overall. Plastics break down into tiny pieces that then become microplastics. Birds eat them. It gets into our water. It gets into our food supply, all sorts of problems. So it's actually single-use plastic that is the problem, not just straws. Starbucks has been talking to us, so they know this, right? But to please the consumer, who they think is not smart enough to realize, they'll replace it with this sippy cup lid thing. That's an example of a terrible commitment that we are not going to be happy about and that we will call them out. And there's lots of examples like this. Another one is the Alliance to End Plastic Waste. Sounds like a great thing. What it actually is some companies joining together with industry and oil producers to basically ensure that plastic still has a share of the market. And so we call that out as well, because if they're just fighting for the survival of this destructive material, that's not a good way to go. And there are companies that we have campaigned on that may be here as well that are part of that alliance. And so that's something that we will also say is not a good thing. So if you're focused on reduction, that's good. Anything else that's contributing to this throwaway, relying on recycling, which is a broken system, or cleanups, we shouldn't have to do cleanups if there was a system that was working in the first place, because this stuff wouldn't end up where it shouldn't be. So it's a pretty clear distinction for us. Reduction is great, throwaway, not great.
Cool. And in terms of a consumer social pushback, do you have an example? Because you mentioned earlier with Starbucks, like nobody has realized actually nothing good has been done, let's say. Like in terms of social pushback, do you have an example of how that went down?
Yeah, I mean, our supporters, I would say, are really great at this. So we did a pretty big campaign on Nestle in the spring, March and April, and it was actually pretty fun. We delivered these giant plastic monsters to Nestle headquarters all around the world, asking them to reduce their production of single-use plastic. And once we kind of finished that push that we did, it was amazing. On social media, anytime Nestle would say anything about a commitment they were making, our supporters and just people around the world were attacking them on social media, saying, you're not talking about reduction, this is greenwashing, calling them out, and that wasn't even us anymore. It just, this public wave went against the company and called them out in a way that we probably would have, and we didn't even have to do it. It just kind of started to happen on its own. So people are definitely getting smarter to the plastics issue and being able to distinguish between the good solutions and the not good solutions. And people don't want to be treated like they're stupid, right? So the more people learn about the issue, which is what we're out to do, is educate them, the more people will be able to discern the good ones from the not good ones. And it's massively changing. Like it's the people that invest in the right types of solutions are going to do really well, and the people who stick with the status quo, business as usual, are really going to suffer in the next several years because it's changing fast in this issue.
Right. So James, in your report, you mentioned that these type of ESG controversies have cost investors a lot. But let's start here. What's the ESG efficacy as a factor?
Sure. So we've maybe I'll just briefly set the stage by explaining what we do as a team. So we look at a lot of different data products, and ESG is one of them. And for ESG ratings, in case you're not too familiar, there are ratings providers out there that essentially kind of like credit ratings providers like S&P and Moody's. What they do is they go through each company and rank them on different ESG topics or issues like carbon emissions footprint, et cetera. And they aggregate that up to the overall ESG score of a company or a environmental score of the company. So what we do is, or what we've done is, we looked at a lot of different sources out there, and we published a note covering, 3 of the major or mainstream data vendors, MSCI, Sustainalytics, and Thomson Reuters. And we've looked at essentially all of their, overall ESG scores and ESG pillar scores, and then like the most granular level of the data. And what we've found is that, it doesn't matter which data vendor or data source you use, there is an efficacy in terms of mitigating risk and generating excess returns using ESG factors. So for example, using any one of the 3 data vendors that I just mentioned, if you just invested in the top quintile stocks by the overall scores, you would have outperformed the market by at least 3 percentage points per year over the last 5 years. Obviously, there's a lot of it is driven by flows and re-ratings of the stocks, and there are some factor attribution stuff that needs to be worked out there. But 3 percentage points per year for 5 years, I think that's pretty strong. And what's even more impressive is when you look at ESG factors as sort of a risk mitigator factor, when you look at earnings volatility of companies that have bottom quintile scores by any of these vendors and top quintile scores of any of these vendors, you see their earnings volatility pick up significantly if they have lower ESG scores. And then lastly, I think on controversy, we found that if you have, we actually looked at 24 of the major S&P 500 stock controversies over the past 5 years. And what we found is that, if you invested in these stocks, you would have lost $500 billion of market cap. And that's against the backdrop of S&P rallying 6% a year. So that's a pretty significant tail risk that, as a portfolio manager, you definitely want to hedge out. So these are, just, I guess, 3 of the top 10 reasons, you should care about ESG.
Right. Thank you for this introduction. So now I'd love to hear from both of you, Jonathan, James, our ESG and alternative data experts. What type of alternative data sources do you incorporate in your process? It would be great if you could define the environmental, social, and governance aspect of it.
Yeah, so I think one of the things I want to highlight first is just highlight some of the comments that people made that I think are very relevant for the ESG data perspective. I think that what a lot of investors and corporates sort of get wrong is that looking top down is, I think, sort of the wrong way to think about these issues. I don't think of ESG as a separate theme than anything else we've been researching. We're trying to find good stocks, we're trying to find good investments, and a lot of the comments that were made on the panel already were about looking for growth in different areas, sustainable products, and looking at the IRI or Nielsen sort of scanner data, which is an alternative data set, is an easy way to identify which areas are growing, what theme is growing. It's really about trying to identify those drivers and looking for interesting ESG or social issues that are related to that major question about growth. The other comment I'll make is that when we evaluate ESG data providers and data sets, we were joking backstage, the data landscape is a mess. Companies that are seemingly reporting all the same metric, like carbon emissions, some companies only report on half their firm. Some companies report on different parts of their firm. I was telling them about this one company in China that reported their carbon emissions, but then just decided not to mention that they own 2 different power plant, electric producing power plants, which increased their emissions by 5-fold. And so I think what's important for us is to kind of external measures or for ESG or any other metric that we think is relevant for future growth. And I think like working with firms like or groups like the ones on the panel where they have external data on maybe plastic production, that could be something very interesting for a fundamental analyst to look at. And the way to kind of really relate that to the performance of the company is to think about how could this be important in the future? Is it important for the profitability? Is it important for headline risk? Is it important for regulatory change? If there becomes a big regulatory change, that could be a real significant risk. And it's not an ESG issue. It's an issue that happens to be labeled as ESG, but it's really about the fundamental parts of the running of the business. And that, I think, is what's interesting. Then you can expand it out and say, what are some other issues that are important here, like employee satisfaction. That's sort of an ESG issue. It's more of an S issue. How are you treating your employees? And you can, like my slide sort of suggested, you can web scrape the internet to get measures of that. There are data, websites where employees will rate their employers. There are companies that will rate their firm or groups that will rate companies on how happy their employees, how good are their benefits. These are things that are not material are very material from an ESG perspective, but they're also material from an actual business and making money in the market's perspective. So I think that's something that we try to emphasize to our analysts. To don't think of it as an ESG issue. ESG issue is really important, but it's all sort of connected to what we're trying to do as analysts in general.
Right, James, anything to add on that?
Yeah, so you actually hit on 2 of the top 10 reasons we talked about. My goal today is to talk about all 10 of them. But so our number 10 reason in our report was actually you already care about ESG. So ESG is definitely a new term, a new umbrella term that we're using to sort of group all of these topics and subjects and issues. But obviously, if you're an investor, you would care if your investment, if your company had a lot of assets or physical properties or plants in areas where it's going to be increasingly more susceptible to floods or other climate change risks. These are material risks that you've always considered as an investor. We're just labeling them as E, S, and G factors. So I don't think there's any difference. The only thing we're trying to do right now is codifying some of these issues and quantifying what these issues really mean as a consideration for your investments. On the alternative data set, we've looked at, aside from the ESG data sets that I mentioned, the vendors, we've also looked at a lot of different interesting data sets, and we actually used Thinknum for one of them. We got the Glassdoor ratings data, which going back to your point, happy employees, we think that has an implication for companies' financial performance. There's not necessarily a really good way to measure that, right? So what we ended up doing was we downloaded all the Glassdoor ratings through Thinknum, and we looked at companies that are ranked highly on those ratings versus the lower ranked companies. And what we found is that over the past 6 years, again, there's a 3 percentage points outperformance in the companies or from the companies that are ranked highly on Glassdoor ratings. And this is just one example of numerous different alternative data sets that we look at to sort of identify sustainability practice of companies. But I think what's ESG is it's a little bit tough. Again, we've joked about the data quality stuff, but there's a lot of work to be done in terms of standardization and data availability. Again, if you ranked every company on ESG ranks, you will obviously see some size bias. A lot of the smaller companies just can't afford to have a team that answers all the questionnaires to ESG ratings vendors and make sure all of your all the good things that you're doing get reflected on your ESG ratings. So a lot of those issues are challenges to ESG investing, and I think alternative data sets can be really helpful in tackling some of those issues.
Great, thank you both, James, Jonathan. And as we're coming to the end of our time, I have one last question to all of you here. How do you see ESG evolving over the next 5 years? So in your reports, you covered what happened over the last 5 years. Tensie and James, you've done that. And it would be great to hear more about the future. Tensie, any thoughts on that?
Well, so if we think about data and sustainability in the future, I think first of all of these environmental and social issues, from climate change to social inequity, are affecting all businesses of all types. And in order to manage for those issues, in addition to doing things in order to do things in a more sustainable way, you need often data to be able to do that. When I look at sustainability, I see it as sort of the next wave of good management, the next wave of innovation, and the next wave of scenario planning, the next wave of investment, and all of that needs data behind it to better understand how you do that. How do you make decisions? Data on what your business case is, data on what kind of impact you're going to have when you try to come up with a different choice that might have worse implications than your first choice, right? So I think those here in the audience or elsewhere who start to develop tools, there's a lot of, for example, AI and sort of data related to food waste. We waste 40% of our food. There's some really interesting business opportunities that are being developed using data on how you better manage for food waste. So I think, as I look 5 years out, we've got massive challenges with our current way of doing business that we need to change, and data will be a part of that and part of that solution.
Great. Then Jen, anything to add?
I mean, I can speak to the plastics issue. It has exploded in the last 5 years, and we know it's just going to continue. And there's pretty widespread agreement, even among the companies, the public, everyone who works on this issue, that things are going to change dramatically in the next 5 years. And so it's really, there's money to be made for those that invest in the right solutions, which again is the refillable, reusable thing. So anything that you can stop needing to use single-use products is going to do really well in the next 5 years, massively well. And anything that's sticking to the old business as usual scenario is going to suffer. And just for example, that report I showed you with the cleanups, we call them brand audits. So that's where we tally the companies that are found. This is only the second year that we've done it, and we've had massive media coverage over that. The companies hate it, of course, because no one wants to be named in a report like that. And this year we had 3 times as much data as we did last year, and it's only the second year. So that is something we plan to do every year. So that data set is just going to grow and grow and grow. And no matter what you're making the throwaway material out of, if you find it in nature where it shouldn't be and we're documenting that, that's not good for business. So anything that can keep you from getting your stuff where it shouldn't be and replacing it with a refillable, reusable system rather than throwaway types of products is good.
James, Jonathan, we still have 2 minutes to go, so please.
I guess 2 quick things first on data. I think we're, over the past 5 years, we relied heavily on disclosed data from companies, but I think there's a lot of new products out there, that are running a lot more sophisticated, techniques like NLP and machine learning on news outlets, et cetera, as ESG is becoming, more more of a hot topic issue, even in emerging markets, where obviously there's no standardization. There's a lot of lack of data, and I think some of the alternative data sets that are leveraging NLP and other techniques are going to get a upper hand in this ESG investing, ESG data set landscape. The other thing I want to quickly touch on, and going back to Jonathan's comment on top down versus bottom up, I think from Bank of America research, our perspective, I completely agree with what you just said. We're pushing our fundamental equity research analysts who cover individual companies to incorporate a lot of these ESG considerations into their analysis, because at the end of the day, every company, every investment has a different ESG risk exposure and characteristic, and I think that has to be done, that analysis has to be done by the fundamental analysts.
Yeah, so I'll just kind of make two comments I think could be interesting trends in the future. The first is kind of the capital markets and NGO relationship. I think could be something that could be developed in the long run, where they have interesting data sets, they have different missions, but we actually also sort of have similar missions. In thinking about the plastic issue, we want our investments to do well, and so they may have interesting data set that we can push on our companies and have useful engagements that could be valuable from a stock return perspective too. And then the second comment I'll make is I think that corporations are going to be starting to want to manage their own footprint and their data that they can see in the outside of their own firm. That's kind of what the whole point of this discussion is with external data. And I think more and more companies like Coke or the Starbucks, like you mentioned, they're going to monitor how is their Twitter footprint looking for their ESG issues, or how do the major NGOs, or how are they rating us on our employee benefits? How are the NGOs rating us on plastic usage? That's important for them to know internally, so they can measure whether or not they're doing a good job or not. And so that's another area where corporates are going to start to demand a lot of the similar data that we want as investors and that they want as NGOs. So I think that's sort of a broad level theme of why this data is becoming more and more important and more useful.
Okay, thank you everyone for sharing your expertise with us today.